Welcome to the Engineering Economic course. We are going to see today the lecture number 10, Net Present Value, based on the discounted cash flow analysis, which is the DSV. This is a very well-known technique used for evaluating investment projects. It's the most used in the world. So we are going to see very detailed. Welcome to the students who are on the session. If you have any question, please you can do whenever you want. So let's start with the lecture. You have the slide in the Moodle, so you can download and follow the lecture with this. First at all is to remember the recommended textbook for this course, which is Chan S. Park, Fundamentals of Engineering Economics. And what is an introduction to the discounted cash flow techniques and the net present value techniques. Both are the same. The payback period we were talking yesterday, it was widely used before the 50s. And this payback period calculation and methodology used for investment analysis was very well known at those years. But what happened, as we explained it yesterday, this payback period methodology has serious flaws. As you remember, the most serious flaws were they ignore the time value of money, because they ignore cash flows after the payback period, and then in the previous periods before to the payback period, they ignore the composition of the cash flows. Why is that? Is because, as you know, payback period methodology ignores the time value of money. But those 50s, those years, different researchers were trying to find advanced methodologies for financial analysis, and then they developed the well-known and the most used today methodology, which is the discounted cash flow methodology, which take into account the time value of money. The discounted cash flow technique takes into account the time value of money for calculating the final parameter we are going to use to evaluate, to assess every investment project, which is the net present value of a project. This is the last number we are going to use to compare, to accept, or to reject investment project. And the technique we will be using is the discounted cash flows technique in order to get this net present value. This concept we were talking before is what is a capital investment project. As you remember, a capital investment project is a matter of determining whether a project is interesting or not. So what we do is to calculate the net cash flows of the project, which means inlays minus outlays of the project. And then what we do is to assess if those net cash flows are sufficient attractive to invest our funds in that project. What does the net present value technique do with these cash flows? The net present value technique use something we know very well, which is the cash flows equivalence over time. So future values, present values. So specifically, the net present value calculates the present value of cash flows at time zero. So this is the most important. We are talking about present value. And if we compare the net present values of those net cash flows of different projects, we can choose and we can order between among them. So it's important to use the net present value technique for that, to select alternative projects, investment projects. And of course, as the net present value of a project is as higher as more interesting will be to invest in it. This is what I have said about using net present value for selecting among several projects, alternative projects. So just to remember, the capital investment project is composed of a capex, which is a negative sign. Usually, those capex are used in the first years of the project to invest in the assets, and then in the future we have both receipts and payment, which are inlays. This is the receipts with positive signs, and outlays, the payments with negative signs. So we can calculate for every year, as you know, the net cash flow. And then the net cash flow is cash inlays minus cash outlays, which is receipts, minus capex, minus payments. So we have here the capex, we have here the under or below zero, we have the payment, the outlays, those ones. And in green color we see the receipts, those ones, and then the net cash flows is the blue one. As you see, this project, the first 2 years has negative net cash flows, which means they need to get some money for finance it in terms of shareholders' money, equity, or in terms of debt from a bank or any debt provider. And then from the second year, we see here a positive net cash flows. Then, what is the net present value criterion? This is the most important slide in terms of providing the formula we are going to use. As you see here, we have expressed here these net cash flows, the blue ones, those. We see here the net cash flows of the project. So a previous step is to calculate net cash flow, and as we have those, then we start to calculate the net present value. So we have the net cash flows of the project for every year, and then what we do is to discount each net cash flow for every year. To discount, which means, as you know, is to move backward to the present. So how do we move money in the future to the present? Dividing by the term 1 divided by 1 plus the interest rate or the cost of capital to the power of k, being k the year we are evaluating. So this is the discount factor, as you know. And then we will be dividing every cash flow of every year, for example, cash flow of year 5, divided by this discount, divided or multiplied by this discount factor. So this is cash flow in year 5, divided by 1 plus cost of capital to the power of k. And then what we do is we calculate for year 1, for year 2, for year 3, for year 4, for year 5. We calculate the present value of those cash flows, and then the cumulative sum of those present values is the net present value of the project. As you see here, the formula is sum from k equal to 0 to n being the number, the service project, the life of the project. We see here the sum from 0 to n, the service life of the project, of the present value of every year net cash flow. So we develop this formula, and then dividing every net cash flow by the discount factor, or multiplying by the discount factor, which is this one. And then also we can summarize this formula expressing the formula of net cash flows, which is inlays in GRK minus outlays in GRK divided by 1 plus cost of capital to the power of K. So this is the general formula. We can apply by hands, with a calculator, with a financial calculator, which is my best preferred option. Also, of course, the other preferred option is to use, when you have a complex business model, to use the Excel formula we have in the Excel, provide us the formula of net present value. So how we calculate the net present value of with Excel, it's important to know that there is a specific issue in relation with the Excel formula of net present value. As you see here, we are calculating the net present value of the project by adding up the cash flow of GR0 plus the net present value. This is the Excel formula, the net present value, this part of the formula, net present value of I being the interest rate or the cost of capital, and then what we write here is the full chain of net cash flows, for year 1, for year 2, for year n. So as you see here in that formula, we don't include in the Excel formula, which is this one, we don't include the cash flow of year 0. Why? Why? This is the way Excel works with this formula, so we have to include the cash flow in year 0 outside the Excel formula for net present value. So as we want to know the net present value of the project, we have to include the cash flow 0 of year 0. This is an obvious question I would like to ask you. Why don't we divide the cash flow of year 0 by the term 1 plus key to 1 plus cost of capital I to the key power? Because in that case key is equal to 0, and then this term, the discount factor for present value of current cash flows of GR0 obviously is the same value. So the present value of cash flow 0 is equal to cash flow 0 because this term is equal to 1. So I think it's clear, this formula. Do you have any question? Okay, we can continue. So we have here a detailed methodology for calculating the net present value. First step by step. The first step, this one, is to determine, we are going to see now how to calculate, to determine the interest rate, or I prefer calling, in general in the industry, financial industry, they call the cost of capital, which is the minimum expected return of every project a company invests. So this is the cost of capital of the company. So as here is explained, is the project that the firm wishes to earn on its investment. The other parameter we have to determine is to determine the service life of the project, the number of years of the life of the project, and the other one is the third step is to determine the cash inflows for each period over the service life of the project. So we are talking about the positive cash flows, the receipts. These cash inflows can be developed by sophisticated formulas. Imagine you are trying to estimate or to calculate the inflows of the FiOS project we were talking yesterday from Verizon, the telecom operator in United States, developing a fiber optic networks. So the inlays will be the incomes, the revenues, the sales of this operator. And then those sales can be quite complex, expressing in terms of number of customers for 20 different products and with different market penetration, with different number of customers every year, with different time evolution, one growing at a rate of 5%, another product growing at 10%. So you have 20 different products with different market penetration curves and different. So that can be quite sophisticated. That's work we will do in our engineer or consultant life. Sure, we will do. And then, but in terms of the net present value, it doesn't mind the methodology you use to estimate the inlays. What is important for the net present value methodology is to know the inlays and to use them correctly. The same happens in the step number 4 with the outflows. The outflows will be usually the capex of the project, the capital expenditure. So you can have very sophisticated model of network deployment and with different kind of deployment curves like logistic, S curves, many exponential. You can invent or you can develop many complex model for estimating the capex of every year, and also for estimating the different operating expenditures of the project, the personnel, the operation and maintenance cost, and so on. So you can develop quite sophisticated also models, quite sophisticated for determining those OPEX and CAPEX. But the most important for us is that we just need to know the outflow, the final numbers. What we will do in the 5th step is to determine the net cash flows for each period. As you know, the net cash flows will be the inlays minus the outlays. So what we have got in the 3rd step and in the 4th step. So as we have the net cash flow, we can proceed to the 6th step, which is find the present value of each net cash flow. So we will be discounting every net cash flow of every year for year key. We will be discounting. Discounting means the mathematical operation to calculate the present value, so the today's dollars or today's euros of future net cash flows. So it means dividing the cash flow of GR key divided by 1 plus the cost of capital I to the power of K, of key. And then as we have the the discounted cash flow for every year, we know the discounted cash flow. This calculation, I haven't said, this calculation of taking every net cash flow in every year and discounting to move backwards to the present, to the current time, this is the discounted cash flow. So when I say a discounted cash flow, what do you have to think is that I'm taking a future cash flow, for example, in GR3, and then if I say the discounted cash flow of GR3 is that I have divided the cash flow of GR3 divided by this term of 1 plus I to the power of key. Then, as I have the discounted cash flows of every year, what we can do now is to add up all those cash flows, discounted cash flows, and then their sum. This sum will be the project net present value. So the net present value will be equals to the summation from 0 to n, which is the project life, of the discounted cash flows of every, this is key, so if every key. So that is the formula of discounted cash flow. And then, as you know, we don't have to lose what is our target. With those methodologies, our target is to know if a project is acceptable or not, and then we have to reject that project. So what is the most important use of those methodologies is to qualify every investment project and then decide if we accept or if we reject that project. So what is the merit of a project? The rule. A project qualifies in that way. If the net present value of a project is higher than 0, we will accept the project. So go on. If the net present value of the project is lower than 0, so it's negative, we will reject the project. So this is the worst case, that we will reject a project. So now, in a few slides later, we are going to see what is the meaning, the real meaning of net present value. So let me explain later what is the meaning of a net present value higher than 0. Any question? Okay, so how do we use? We have used this rule, this criteria for merit of a project is for qualifying a single project. So, but this methodology, the net present value methodology, is quite useful not only for evaluating single projects, but also for comparing several projects. As you remember, the general framework of an engineering company investing in different or planning to invest in different assets is that every project, every investment project proposal has its net cash flow. And then what we do is to select, to filter those projects, to select those projects that are acceptable. So if we have several projects that have passed this first filter, and now what we want is to order those projects in terms of the attractiveness of their attractiveness. So provided that every project has the same service life, we calculate the net present value of every project, and then which project we will choose. We have the net present value of project 1, the net present value of project 2, and the net present value of project 3. So all of them, they have net present value higher than 0, so they have the first, they pass the first filter. So, but we have to choose among them. We will choose the one with the highest net present value. I will tell later, but the net present value is the money a company will earn from a project, and then what a company have to do is to choose the projects with higher future income for the company. So that's the general rule. So the project can be ordered from the highest to the lowest net present value, and then we will choose the highest net present value. There are some specific problems that can arise when you compare projects with different lives, and then this requires special assumptions, but we will see in an advanced lecture we will be providing in the future. So we have here the net present value calculation. We have prepared an example of this, and we have here the project cash flows expressed in million euros. The interest rate is 15. And the cash flows are those one, the capex, the receipts of the project, and the payments. The project life, as you see, the service life is 7 years. We calculate here the net cash flow, as you know, is the sum of those cash flows, the in-lies minus the outlies. And then we calculate here, I suggest you, I recommend you to use this methodology I'm using because it creates you a lot of safety in what are you doing. Is trying to do by yourself the calculation and then just at the end comparing with the net present value formula of Excel. So how do we by our hands we can create these discounted cash flows? I have used it in every year this formula, the present value of every net cash flow. So for example, the net cash flow of year 3, this one, 180 euros or million euros, 180 million euros. What I see here? Oh yes. Okay, so this the discounted cash flow of net cash flow 180 is 118. So how do we get that number 118? We see here this formula. In year 3 we use the 180 as in the numerator, and in the denominator the discount factor we are using is 1 plus the cost of capital, which is 15%, to the power of 3. Power of 3, why? Because we are in the 3rd year and we are moving this cash flow in year 3 to the year 0, to the current time, to the present time. So we discount to the power of 3. So I think it's quite straightforward to apply this formula. So what you see here at the end is that I accumulate all those discounted cash flows, and the cumulative discounted cash flows is the net present value of the project. So as you see here, the net present value, the cumulative sum of the present value of every net cash flow from year 0 to 7. And then the first term is the cash flow in year 0 is not divided because it's to the power of 0, which is 1. And then we find here with its own sign, we see here the first year cash flow, net cash flow, which is minus 100, divided by 1 plus 15% to the power of 1, because we are discounting the first cash flow. So we sum the second year discounted cash flow, the 3rd year discounted cash flow. As we have explained it, the net present value is the summation from 0 to the service life of the project of discounted cash flow of every year. And I recommend you to use to calculate by yourself the discounted cash flow of every net cash flow for every year, and then making the cumulative summation of that. And then also you can check if your calculation is right using the Excel formula. The blue calculation you see here is the own calculation by applying this formula, the discounted cash flow, the summation, and the orange one is the net present value calculation according to the Excel formula. So we have here the formulas used on the Excel. So what is important for us is to know how we calculate the net cash flow. How do we calculate the net cash flow? We use the formula of Excel, sum, from cell B3 to D3, so we are assuming this range, and so on for every year. And then what is the discounted cash flow for every year? Let's see, for example, year 3. we will using the cell E6. E6 is this one, E, this is the column E, and this is the row 6, so E6 is this one, the number 180, divided by bracket 1 plus an absolute reference, which is $F$1. $F$1 is this cell, the interest rate, the upper corner on the right. Close brackets, to the power. You see, you know, to use to the power in Excel is to use the character, this one, I don't know what's the name, circumflex accent or something like that, to the power of, and then we use A6. A6 is this cell, this is the column A, and the cell is, so we are raising to the power of 3. So this is the calculation, and then we have for every year the calculation, and then the cumulative discounted cash flow is this summation from this cell, the cell F3, this one, to the cell F10, which is this one. So we we add all those numbers, those cells, and then this is the number 305 euros. What is the Excel formula? As I have explained it before, most important and very important to know, to remember every time we use the net present value formula of Excel, is that it ignores the formula of net present value is this one, VNA, this is Spanish formula. In English will be NPV, net present value. So the NPV formula refers to F1. F1 is the cost of capital, 15%. And then you see a reference to the cell from E4. E4 is the net cash flows. So you have to use, not here in this formula, you have not to use the discounted cash flows, because what this formula does, this formula is to calculate the discounted cash flow. So you have to use in the formula the net cash flows. So the column E, this one, the net cash flows from year 1, this is the column, the row number 4, to the number 10, which is this one, the last one. So you have to use in the net present value Excel formula the cash flows, the net cash flows, not discounted, from year 1 to year n. And then to correctly calculate the net present value of the project, you add to this Excel formula, you add the net cash flow of year 0, because this year 0 has no any discount factor, because it's 1. So, any question? So by this way, you are able to apply for any kind of project the net present value calculation. Okay. One important fact is that we have to deepen in the net present value calculation, and one fact is the effect of interest rate. We have used 15 in this project. What is the effect of the interest rate in the net present value formula calculation? Because as you see here, let me delete, no, okay, this one, okay, let me erase those. So you see here Okay. You see here that every net cash flow is divided by the interest rate. So as is dividing, any increase on the cost of capital, on the interest rate, what will happen is that the discounted cash flows decrease. So there is an inverse relation. As the interest rate increase, the discounted cash flow of every year, and of course the net present value, decrease. So there is an inverse relation between both. So if we increase the interest rate of this project, the cost of capital of this project, let's say for example 20%, what will happen is that those cash flows will be, discounted cash flows will be lower, because we are dividing by 1.2 and not by 1.15 as before. So as we move from 15% of interest rate of cost of capital to 20% cost of capital, the discounted cash flows will reduce as we are dividing by a higher amount. So this is what we are going to see. The different net present values we can obtain from a project depending on the varying cost of capital, depending on I. So what we have done in this table is to, for the same project, this one, for this project, what we have done is to change the interest rate, this interest rate, and write and record the net present value for every interest rate, and we have generated this table. So as you see here, in our case was 15. The 15 case was the NPV was 305. And then we started with low interest rate, low cost of capital of 3. We will steeply increasing at a rhythm of 3. So 3, 6, 9, 12, 15, until 45. And we have recorded all the all the net present value, the NPV of every interest rate, and you see here the corresponding chart. We see here the net present value, and we see here the cost of capital I and the net present value, the NPV, and we draw here each pair of interest rate and net present value. And we see here the zero axis is this one. And we see here that for certain interest rate, near 36, the NPV of the project becomes below 0, lower than 0. So exactly this happens at an interest rate of 35.70%. So at this interest rate of 35.17%, the net present value of the project is equal to 0. So as you remember, we used a rule for accepting or rejecting projects. We said that we will use the net present value for accepting or rejecting projects. Net present value higher than 0 will be accepted, and net present value below or lower than 0 will be rejected. So as you see here, for interest rate, expected interest rate generated by this project higher than 35%, this project will be rejected. So there is an area of acceptance of the projects. The area with interest rate lower than 35, and there is another area of rejectable projects of interest rate for this project. So this area of higher interest rate than 35, we will reject. So what we have learned in this slide, that there is a threshold for accepting or rejecting a project. This threshold is what we call, this concept, we call this is a break-even interest rate. Break-even in the sense of net present value becoming zero or below zero or lower than zero. And then this interest rate, break-even interest rate, is what we call the internal rate of return, the IRR. The internal rate of return is very important concept in financial analysis because it tells us what is the internal return of this project, what is the real return of this project. So with this project, with this IRR of 35%, our money will have a return of 35. So that's the main meaning of the IRR. And if we have alternatives to invest in another projects of, for example, an interest rate of, for example, 20%, which project will you choose? Definitely will you choose the project with the higher internal rate of return. So as this project, the project we are evaluating, has an internal rate of return of 35%, any other alternative investment with rate of return lower than this one, we will not accept. So we will prefer always to invest in this project at 35%. So we will ignore projects if we have alternatives with lower interest rate than 35. That is the meaning of internal rate of return. Any question? So let's continue to have a further outlook of this NPV concept. So this is the most complicated issue of this lecture, I think, is what does it mean a net present value greater than zero? So what does it mean that a project has a NPV of 100, for example? What does it mean? So let me explain that. Is that for a firm, for a company, the interest rate is the cost of capital for this firm. So this cost of capital is the cost this firm can borrow money from the capital market. So this is the most important concept of this one of the most important of this lecture, is that the interest rate, the cost of capital, is the cost of money for this company to borrow money from the capital markets. You have to understand to borrow money from the capital markets in a wide sense. So we can borrow money from our shareholders, which is the equity. We can lend as we can buy shares of a company. So we are giving money to this company. And the other way a company borrow money from the capital market is shareholders, and the other is debt markets. So we can go to the bank and so on. So the cost of capital of going to the shareholders, asking their money, their equity, or going to the debt market, to a bank for asking them for a loan. So the cost of this is the cost of capital. So what happened is that if a project has a net present value greater than zero, higher than 0, what happens is that the project is generating a profit, an additional profit respect to the cost of capital I. So if the net present value of a project is 60, what does this net NPV tell us is that this company is getting 60 units more of money from this project than investing in other project at the cost of capital of I. So we have to think that the net present value is a premium we get from investing in every project. A premium in relation to the cost of capital of the company. So this is a very, 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 very important concept. So with a project with net present value pays, with this project, is able to pay the cost of capital. This is, I think this is a misprint. A project with net present value pays the cost of capital, but no more. No, this is wrong. Excuse me. This slide, please correct this message. A project is the right one, this one, the correct I'm saying. A project with net present value pays the cost of capital I and more. It's not and no more, it's and more. How much more? 60. So what happened in the case otherwise? What happened if the NPV of a project is lower than 0? So this project with NPV lower than 0 generates losses to the capital providers. In that case, to the company. So if the net present value of a project is minus 30 units, what happened is that this project, if the cost of capital is 10%, what happened is that this project is not paying the interest rate. So the incomes this project generates are lower than the 10%. So that's the reason we reject project with net present value lower than 0. Therefore, the most important message is this one. The net present value is a premium that a project has, investment project has, respect to the cost of capital. So if a project has a net present value of 60, the interest rate is 10%, and the net present value of the project is 60, this project is generating a premium of 60. And then most of you will ask, and then what is the real return of this project? Because you say that if we have a premium in relation to the cost of capital, so can we relate that premium with the invested capital? Yes, of course. We can compare that interest rate, that net present value with invested capital, and that concept is the one we have learned in the previous slide, is the internal rate of return of the project. So let me go back to the previous slide. As you remember, let me delete this one, erase this one. Okay. The internal rate of return of this project is 35%. IRR 35%. This point here. And at this point, the net present value is equal to 0. I have said if my cost of capital, for example, would be this one, 25%, at 25%, the net present value is something like this one, 24, more or less. The net present value at 25% is equal to 132. So this is the situation we were describing a few minutes ago. So what is the real return I'm getting from this project? The real return you are getting from this project is 35, the internal rate of return. Because as you see, you can discount with a higher interest rate factor every cash flow, moving from 25 to 35, and then the net present value of your project will become 0. So it means that this is the cost of capital, no, this is, excuse me, the return of the capital you have invested, 35%. So we have learned a lot of important concepts, I think. So let's have a break. Have you got any question? Okay, so let's have a break. So we have next slide is this one, is the meaning of the net present value. So what I suggest with this slide and the next one is to have a look yourself, and because it's a bit complicated to explain and to understand, and we don't have so much time, but I think it's important that you understand. So the idea is we are going to see the NPV meaning from the point of view of an equity holder, and in the next slide from the point of view of debt holder. Okay, so let me explain. As we have said, EI is the cost of capital, and we have said that this cost of capital is the cost of this company for going to the capital market and asking for money. We have said that the capital market, so the money a company can borrow, can come from the shareholders. This is the equity, the shareholders' money, and also from the debt providers like banks and so on. At the end, the company will have a structure of its capital composed of a part of this will be equity tranche portion, and other portion will be debt. So let's suppose that in this slide all the capital of the company comes from the equity, from the shareholders. So this company has not any debt. And then for any investor, for any equity holder, every investment is defined by its internal rate of return. So it's defined by the money this investor, he or she, can earn on this investment. So any investor will choose investment with higher rate of return. So any investor, we were talking about the alternatives that an investor have, and we are seeing here two alternatives of an investor. He or she has 8 euros, and then he has two different alternatives to invest. One is to invest in a deposit in a bank at this interest rate, I. And the other is investing in this project, with these cash flows. And then we will use in this project also the same interest rate to compare if the net present value of the project is higher than 0, the project is more attractive than the deposit. So that's the way we are going to explain now, is that one. If the project net present value is higher than 0, then the project deserves against the deposit option. So that's the usefulness of NPV. We calculate the future value of the deposit. So the first step is here. The project cash flow versus the deposit. We have an investment of 1,000 euros. We have an interest rate we can get from a deposit in the bank. We go to the bank and ask for a deposit, and they say, okay, we will give you 6%. And then you have to let your money here for 5 years. So the service life of this investment is 5 years. And then we can calculate the future value. The future value, this formula, you know, this is the present value. The 1,000 times, in this case is we are capitalizing the money, so we multiply, we don't divide, we multiply by 1 plus the interest rate to the power of 6. So this amount, the deposit future value, will be in 5 years from now 1,338 euros. So the other alternative this investor has is to invest in our project. So we will use the interest rate. The best alternative, or the alternative the investor has, is instead of investing in our project, is to invest in a deposit. So we will use the 6% of the deposit as a benchmark for comparing both investment. So we have this investment project, those in lies, those out lies. This is the net cash flow, we know to do all of that. We are going to calculate, not in the previous case we used it to calculate the net present value. We are going to use to calculate the future value of those net cash flows. So we are moving the cash flow to the year, to the end of the year. Why to the end? Because the same we have done with the other alternative investment, which is the deposit, we have calculated the future value of the deposit. So if we want to compare the project investment with the deposit, we have to move the money to the same time. So we have chosen to move to the future. And then how we move present or every year cash flow to the future is to capitalizing this money, this net cash flow, so multiplying every cash flow by 1 plus interest rate. So this is the future value of the net cash flow. If we make the cumulative sum of those future values, we have the cumulative sum of this investment, which is 1,501 euros. So as you see, from that point of view, the decision is clear, because this project has a future value 1,500 euros, which is higher than the future value of the deposit, which is 1,338 euros. So definitely we'll choose the project for invest, because as you see here, the investment is, the future value of this of the investment is higher than the deposit one. So as we have explained it, the net present value is like a premium. Let's talk that cash surplus. The cash surplus we get from the project is the subtraction from the project minus the deposit future values. This is 163 euros. So if we move, this is a future value. if we move this future value in year 5 and then we calculate the present value of this future value, this present value of this surplus, of this difference, is 122 euros. So what is this number? Let me explain. Another thing we can do is to calculate the net present value of the project. This is straightforward, we have done before. We have the net cash flows, we have the discounted cash flows, and then we summarize all of them. And this number is 122. So as you see, the present value, the NPV of the project is the NPV of the project is 122 euros. And the net present value of the surplus is the additional amount of money we get in the future from the project, from investing in the project, instead of asking for a deposit. This surplus, the net present value, is also 122 euros. So what we can conclude from that is that the net present value is the additional amount of money I can earn in a project instead of investing in a deposit at this same rate, interest rate. So this is the concept of net present value from the point of view of an equity. So this is the main lesson we can get from that. The net present value is the extra premium the investor receives from the project instead of investing in a deposit. This project pays the I% of the deposit and more. This pays a more, we know. This more plus the I is the internal rate of return of the project. Any question? So also we can have this overview from the point of view, we can have this calculation from the point of view of a debt holder. This is a more complicated explanation, so let me just explain the main idea is we have to invest, like in this project, we invested 1,000 euros. In this project also, we invest 1,000 euros. So what are going to do in the calculation to compare with the case of a loan in the bank? In this case, we are comparing not with the deposit, but with a loan in the bank. In this case, what we are going to use is the cash balance of the project, which is this one. This account, this column, will be the cumulative sum of cash flows. This is the project balance. This column. And then we are going to calculate for any negative amount of money of this project balance, we will be using interest rate. So we will go to the bank to finance the negative project balance amounts. And then charging every year in concept of cost of capital this interest. This is this column. So later this project will be generating a net cash flows, and then with those net cash flows we will be paying in one side the interest charged because we are lending money from the bank, and then every amount at the start of the year will be charged by interest. This is this formula, no? 6% by the beginning balance of the project, which is 1,000, is 60 euros. And then at the end, what we'll have is that this project balance in certain time will become positive, because we have paid all the amount lent, and also, as we have positive net cash flows, in certain time the project balance, which has been during all the project negative, so lower than zero, after certain time, in that case in year 5, the project balance becomes positive, meaning the meaning of this one is that we have been able with this project to pay the debt and to get a much more money. So the idea is that also we can explain the meaning of net present value in the case a project is fully financed with a loan. In that case, from this project, if the net NPV is higher than zero, it means that we are able to pay all the interest we are going to be charged by the bank, and also we are getting more money because the net present value is higher than zero. Okay. So another important question is, we haven't talked before about that, is which interest rate, which cost of capital to use in every project. So this is in the literature, like for example the book of Chan Spark, they use the concept of MARR, which is the minimum attractive rate of return. So the rate of return that is the minimum that any investor is expecting to invest in, the minimum return. So the MAR is not a very used, really is not very used in the financial industry, and they use the concept of cost of capital, so we will prefer to use the concept of cost of capital. But in the engineering economics literature is often used the term MARR. So MARR is the minimum attractive rate of return. So what is return in general? Let's remember what is the return of any investment. The return is what you get back in relation to the amount you invested. So if you invest 1,000 euros in one investment project, and then you get from this project 200, this money, 200 is the money you get back in relation to the amount you have invested, 1,000, so 20%. Also, return, it's an important metric to compare different investment alternatives. So we expect to invest in higher return projects than in lower return projects. So if we have to compare and to choose among different, we will choose the project with the highest return. What is the rate of return? As we have explained, it is the amount of money you get back expressed in relative terms compared with the amount you invested. For example, when I say the rate of return 12%, how do we use this rate of return? In this case, if you invest 1,000, then you will have a return of 120 euros, which is the 12% of 1,000 euros. You will prefer a rate of return of 12% instead another of 9. So this is a performance metric. What are the guidelines for selecting the cost of capital? Let me explain something basic about financial, but we need to understand. The rate of return depends on the risk of the investment. So any investor would not want to lose his or her money. So what he's looking for is for low risk project, and as much as higher interest rate, they will be his preference. So in real life, there are increasingly risky situations. For example, very low risk investment. The very safest, the most safest investments in the world, so the lower risk investment, are, at least by now, to invest in the United States or Germany government bonds. What are the government bonds? Government bonds are, as all the states, they need to finance their expenditures in public services and so on. So sometimes they issue new money, not new money. They issue certain bonds, certain assets that gives to the investor the possibility of earning an annual coupon. Or, for example, in the case of US government bonds or Germany government bonds, an annual interest rate of 1.80. So this is not very much. It's quite low interest rate, but the most important thing for an investor is that certainly the risk of losing his money is quite low. Second option you have with very low risk investment is to invest your money in a bank deposit. But as we know, banks sometimes suffer and has sometimes trouble. They are in trouble, as we are seeing now in general economy. So the bank deposits, an investor will ask a bit more interest rate, not 1.80, but a 3%. So it's a bit more, not much more, but a bit more. For example, if we know that the inflation rate is 3.5, is it much return? 1.8 or 3%? Not really, because in terms of real rate of return, as you remember, those rates of return are nominal, but the real rate of returns are equal to the nominal ones minus inflation. So if the inflation is 3.5, every year your money is losing. You are losing your capital, because every year, for example, in a bank deposit of 3%, you are losing your principal 0.5. Then, if you want to get more return, you have to look for medium risk investment. For example, a stock of mature companies like Telefónica, like utilities, like banks in general. Not now. But those are medium risk investment. You go to the stock market and buy stocks of any bank, or mature bank, or any utility, electricity companies, or hydrocarbon companies, or telephone companies, and then you will get probably 5, 6, or 7% every year in terms of return of your money. But if you want to have more return from your money, then you have to assume a very high risk. So, as we are explaining, there is a trade-off. As high is the rate of return you expect, as high is the risk. So the trade-off is clear. And then if you want to get 10, 12, 15, 20, 30% every year of return of your portfolio, you have to go for very high risk investment, like speculative stocks. Sometimes certain stocks moves their prices quite a lot during a day, or during a week, or during a year, what we call the volatility. And what happens is that this is very risky. You can earn a lot of money, but also you can lose all your money, no? And then what are we going to use in the field of engineering project? The risk is moderated, even though they are huge investments. So we often find rate of returns around 10-15%. So use this as a general orientation, as a general benchmark. Ways to estimate is this one. This is the mathematical formula to estimate, to calculate the cost of capital. We see here the formula, the rate of return of a project, I mean the required rate of return, the minimum attractive return is the risk-free return plus the risk premium. What is the risk-free return? As we have seen, government bonds. So if you don't want to have any risk, you go to buy risk-free return, risk-free products, like government bonds, and they pay no more than 1.5, and in the case of countries experiencing some economic problems, like Spain now, the famous risk premium we listen many times in the news, the 5%, this is the differential against the Bund, which is the German bond. This 5% can be used for Spain, but for investment in the United States or in Germany, use please as a risk-free rate the 1.5. And then the risk premium is a premium you want to earn in the case of investing in more and riskier, in riskier assets, like we have been talking. I've been talking about the stock of public companies that can generate certain but is not safe return to their shareholders. So this risk premium can be around 6-8%, and then the rate of return, required rate of return, is the risk-free return plus the risk premium. This is the formula, RFR plus RP. So we have here, for example, several rate of return in the case of request of risk-free rate. This is the Spanish government bond. Now we have 4.91% of the 10 years bond, Spanish 10 year bond. For example, we see here the US bonds. Now they are at 1 point. So this is the risk premium we are paying in Spain. This is, for example, the risk premium. An example of risk premium I have used it here the IBEX 35, which is the Spanish stock index, the Spanish stock market, and then you see here from year April 2012 to April 2013. So this is 1 year. In 1 year, the index has increased from this level to this one at 10%. So we can assume a 12%. Then in Spain, any investment based on those numbers, we will use the 10 years bond of Spanish government bonds, 4.91, and then the Spanish stock exchange annual return of 12%. So the minimum attractive rate for investing in Spain now could be around 16.91, so 17%. This is very high. So that's the reason, as any investment in Spain is divided by this 1 plus 17% to the power of any year. So that's the reason the assets in Spain are quite cheap in Spain, because we are discounting a lot the asset in Spain, because the investors are using those interest rates. What will be the case in Germany? They will be using, for example, 1.8 plus, I don't know, the German stock exchange index, but suppose something like 10%. So they will be using a rate of return required of around 12%. So that's the reason of Spanish assets compared with German assets. The Spanish ones are cheaper because we are discounting very much those rates. Okay, so this is the last slide. No, okay, so let's there are yet, I think, several slides to see, so let's finish here. Any question, students? Slide number 14, guidelines for selecting the cost of capital or minimum attractive rate of return. So we are reviewing again this subject. So as you remember, the cost of capital is the I term in the discounted cash flows or in the present value formula. So that cost of capital or minimum attractive rate of return is the minimum return we expect to have from an investment project. So what is return? Return is what you get back in relation to the amount you invested. So if you invested 1,000 euros and then you return 100, then 100 divided by 1,000 is 10%. So this is the return of a project. And also, if you want to compare different investment alternatives, you have the opportunity to compare them in terms of this percentage, as you know, the return in terms of percentage. So we call that return the rate of return. The amount you get is expressed in relative terms compared with the amount. So this is okay, so the rate of return is the amount in relative terms compared with the amount. So the rate of return of 12, if you invest 1,000 euros, then you will have a return of 120 euros. So this is the 12% of 1,000. And of course, any of us will prefer a rate of return of 12% instead of another of 9%. So in that sense, this rate of return is a performance metric. So as you remember, we were talking about different minimum attractive rate of returns, minimum cost of capital you can consider depending on the risk. So the most important fact is that every investment has risk, and you can't bet on that investment in the sense of achieving more or less the return, more or less the minimum attractive rate of return. So as we were talking, there are increasingly risky situations, like for example, buying low risk investment or investing in low risk investment, like US or Germany government bonds, that they pay those investment pay annual coupon, so rate of return of 1.80%, not much, during 10 years. And then you have another chance with low risk investment, which is to invest your money in bank deposits. You can get 3% of return. And then if you want to increase your return, you have to increase your risk. So we have medium risk investment, like buying stock in the stock market of mature companies like utilities, bank, telecom companies, or any kind of big companies which are their stock are bought or traded in the stock market. And the extreme case is very high risk investment with very high return. But the problem with those investments is that they have a lot of risk in terms of the kind of things you are buying and you are investing. So you are investing probably speculative stock that can change every day or in a week a lot its price. So you can earn a lot of money, or also you can lose all your money. Or even you can buy startup company shares. So you can buy a new company which is starting, and they have promising future returns, and then you invest in that, but probably 50%, more than 50%, of around 70% of those projects in a startup failure. So that is the problem, no? And then you will ask for a return of 300% in 3 years, so which is a very big return, but very high risk. And in our context of engineering, of utility or telecom companies or civil works companies, road or highways companies, the average rate of return is around 10-15%. So it's moderate risk. Because there is risk, of course, because those companies invest a lot of money in big capex in the early start of their business, because they have to create those assets that will be the future. They will return. They will generate the future cash inflows and outflows. But in terms of their kind of business, they are providing telecom services, they are providing transportation facilities for drivers, they are providing electricity or gas to families, and then so this is a very lot of cash business with lot of cash generates every month in terms of service payment. So in that sense, it's 10-15% moderate risk. How do we set up, how do we establish a minimum attractive rate of return in our business, in our DCF evaluation? So this can be the both extreme terms are the risk-free return, so the government bonds and the usual rate of return of those government bonds, we are talking about the annual return, is 1.5% or 5%, around this, depending on the country. US and Germany is 1.5, and Spain now is around 4.50%, and they are often quite safe investments. So many governments return their bonds. They pay the annually coupons, and at the end of the period of the term of the bond, you get back your money. And then you add to that risk-free return. This is the first term of the minimum attractive rate of return. This is misprint here. And the risk, and then we add to this amount of the risk-free return, we add the risk premium. What is the risk premium? The premium, we as investor investing in a riskier project than the risk-free government bonds, we ask to this investment a higher return. So in that sense, we are asking for a premium to invest in that. So we call that the risk premium. This risk premium usually is around 6, 8, or 10%, depends on the risk of the project. And at the end, adding up the risk-free return, which is the RFR, plus the risk premium, RP, we get or we obtain the minimum attractive rate of return. So that's the formula we are going to use every time. So just for telling you about source of information for calculating, for estimating your risk-free rate, this is Bloomberg site. You can go to Bloomberg, it's an open site, so you have not to pay for that. Then you can go and ask for and look for this bond, which is the Spanish government generic bonds of 10 years. So 10 years is the life of the bond. So at the end of you give to the Spanish government 1,000 euros today, and then they will return your money in 10 years from now, those 1,000 euros. And every year they will be paying an annual amount of, in this case, 4.91. This was the price of those bonds, or the yield of those bonds, in the 3rd of March this year. Today, I think this price will be lower, so you will get less money or less interest from your money than in the 3rd of March. So as you see here, this is the time evolution of this value from May of 2012 to April of this year. So you see here the maximum price of those bonds were reached along July and August of the last years. You know, there were a lot of financial crisis, so due to that there were a lot of volatility. So you can choose an average of about 4.5, depends on the bond. In that case, you see here the Financial Times. You can get this information from Financial Times, and you see here in the market section of the Financial Times, you see here the fixed income, which is the kind of financial product are bonds, government bonds, and then you look for bond overview, and you see here the yields, which are the rate of return of the United States government bonds, and you see here that for 10 years the US government is 1.8. As you know, the premium, the so-called risk premium, many people talk about, even the taxi driver or even in the news on TV, the risk premium of Spanish bonds is 4.91 minus 1.8. So this is the risk premium of Spanish government or Spanish bonds, which is about 3.1. So this is when they call the premium, the Spanish premium, risk premium is 310. So this is in terms of basic points. Any question about that? Okay. You see here one way to estimate the risk premium. You can go to the stock market. Of course, we are trying to know, this is an obvious question, perhaps not as obvious, is that every project has its own minimum attractive rate of return. Depends on what? Country. The country, and then also is important the term, the service life of the project. So if the service life of the project is, for example, 10 years, we will look for government bonds to know the risk-free rate. We will go to government bonds of the country we are developing the project. So we are developing an investment plan in Spain, so country is Spain, and then 10 years, this is the service life of our project, so we will look for 10 years Spanish bonds. Okay, so that's clear. And then we have to look for the premium, the risk premium. So as we are developing the project in Spain, the risk premium, as you know, it includes the country risk and the market or the business this investment will be developed. So the risk premium is the Spanish. And then what's the elementary reference for knowing that is the stock exchange index. So the most Spanish stock exchange index is the IBEX 35. So as you see here, we have to look for 10 years return or for 1 year return. Oh, of course, we have to consider the 1 year return, because the minimum attractive rate of return, if a yearly, is calculated as an annual basis. And then 1 year we have here from April to 2012 to April 2013, so 1 year. This is 1 year. And then we have here the index. The index in that day was about, this you see here, what you see here is the index in terms of 100. So 100 is the first date of the series. So, and then you see here the movement in terms of percentage of price movings from this date, April 2012. And then you see here, this is the red one is the IBEX, no, excuse me, the blue one is the IBEX. The other, I think, is a reference. For example, probably is this London Stock Exchange or something like that. And then you see here 10%. So we can consider that 10% as the premium risk of investing in risk premium of investing in Spain. So as you see here, all the information I have provided before. Service life is 12 years, investment in Spain, industrial sector. So instead of using the IBEX 35 as a premium risk calculation, you can use the industrial IBEX 35 index, because all the stock exchange, they are also decomposed in several sectors. One of these sectors is the industrial, so you can go to the Spanish stock market and then know the time evolution of the industrial index of the stock market. So the other question you need to know is the risk-free rate and the risk premium. Then risk-free rate is Spanish 10 years bond. This is, as we know, 4.91. And then the risk premium of the Spanish stock exchange is around 12% annual return. And then the minimum attractive rate of return we are going to use in our projects. So this term will be the term 1 plus I, or cost of capital, or minimum attractive rate to the key. So the minimum attractive rate is equal to the risk-free rate, 4.91, plus the risk premium, which is 12, and then the cost of capital of a Spanish project will be nearly 17%. It's a very high. Why is such a very high? Because the risk-free premium, the risk-free rate in Spain is quite high, compared with 1.9 in Germany or in US. And also the Spanish stock exchange, as we have a lot of volatility, lot of risk. This time evolution of price has been quite high, 12%, and then in another stock can be, for example, 8%, which can be an average, historic average for return on the stock market. So in the case of investing in Germany, that minimum attractive rate will be like near 10%. So we are 7 points ahead. So are you able to understand what is the consequence of having a higher cost of capital in Spain than in Germany? So how can we answer this question? Let me use a white paper, this one. Okay. So the minimum attractive rate of return, this is the cost of capital in Spain, is equal to 17%, and the cost of capital in Germany is 10%. So imagine we have a present value of discounted cash flow of a project equals to 1,000, and then what is the net present value? No, excuse me, forget that. Then, okay. So we have we are going to estimate the effect on one cash flow, future cash flow. This one, for example, imagine this is the cash flow diagram, and we have a cash flow, positive cash flow, net cash flow in GR5 of 1,000. So we want to know the present value of this future cash flow. So the present value of a cash flow in GR5 is equal to, we know, cash flow of year 5 divided 1 plus cost of capital to the power of 5. So in the case of Spain, this is 1,000 divided by 1.17 to the power of 5. And in the case of Germany, this is 1,000 divided by 1.1 to the power of 5. And then, as you know, if the denominator is higher, the result of Spain, this cash flow, the present value of this cash flow, will be lower than the case of Germany. So this is a very important question, because if you are buying this net cash flow, so in Spain you are less interested in buying those cash flows, because the present value, we can calculate with the calculator, let me use it. So this is the financial calculator, you see there, okay, so I'm going to clear the TVM sheet. So n equal to 5, future value 1,000, use negative sign for future value, and then 0 payment, and then the interest rate for Spanish is 17 interest rate, and then compute present value. So 456. So the cash flow for Spain is is 456 euros. What is the present value of this cash flow in year 5 for the case of, will be in a project, investment project in Germany? Let's calculate with the financial calculator. Just the only thing we are going to change is the cost of capital, the interest rate. Instead of being 17 is now 10%, so interest rate 10%, and then compute the present value, 620. So what's the practical consequence? I think it's 620 euros. So what is the practical consequence of that cost of capital? Spanish, excuse me, risk of Spain is higher than risk of Germany. So the risk, the cost of capital is higher in the case of Spain than in the case of Germany. So it reflects. So at DC, as you see, the cash flow models, the discounted cash flows, are very, very, very useful to consider that risk. So as you see here, for example, imagine that you are buying shares of a company, of an Spanish company that promised you 1,000 euros 10 years from now. Or you have another investment option, alternative, which is to buy a German share of a German company, which promise also 1,000 years 5 years from now. So what is the effect of considering the cost of capital of every investment in their countries? As Spain is more riskier, you will be the net present value or the present value of any future cash flow, as you know, is the present value, the present worth of this investment. So in the case of the Spanish share, you will only pay for this investment 456, because you see that as a higher risk than buying the German one, And then if you buy the German one, you will be willing to pay for that 620 euros. Why? Because you see here that your cost of capital of investing in Germany is lower, is 10%, because you see there in Germany less risk than investing in Spain. So I hope this explanation will clarify very well your doubts or your understanding about cost of capital and net present value effect of investment. So let me know then if you have any question. We continue it. And then this is coming back to the presentation. And then just to know this concept of project balance, because perhaps you see certain time in your future to know to draw or to calculate the project balance diagram. What is the project balance diagram? Is no more and less than this calculation. You see here the usual project cash flow, the capex, the receipts, the payment, the net cash flows, and then instead of calculating the discounted cash flow, calculating the present value of the net cash flows, what we do in the case of project balance diagram, if we calculate not the present value of the net cash flows, but we calculate the future value of net cash flows. So it's the same calculation, but instead of dividing by 1 plus the interest rate to the power of k, we are multiplying. So this is for every year the future value of its net cash flow. And then if you make the cumulative sum of those future value, you get this value, which is the cumulative future value of the project. So in this case, if you accumulate all those, if you add up all those quantity amounts, you will get the future value of the project is 112. 112. And then, what is the project balance? Is the cumulative summation of the future value net cash flow. So as you see here, you are accumulating the previous year project balance cumulative to this year future value of net cash flow. And then at the end, you will reach the same amount of the future value of the project, which is 112, is the same than this one, this amount. So here you have the discrete amounts of future value, and then you have here the cumulative sum of those discrete amounts. So the result is the same, but this is the project balance cumulative. And then we can draw this project balance in a chart, and then you see here the years from year 0 to 7, and then we are representing here this column, the project balance. You see here during 4 years the project balance is negative, below 0, and since from the 4th year the project balance is positive, and the final value of the project balance, this one, as you see here, is 180 and 800. This cumulative project balance value is the same value of the future value of the project, 890. Just me tell you this important fact is that this amount resulting from the cumulative the accumulation of the project balance future values, 812, this future value, if you calculate the present value of this future value, this amount is exactly the net present value of the project, which is 305 euros. So just to know that. Why it's useful, the project balance chart? Because you see here different areas important for a project manager, investment manager, which is to know, for example, the depth of the negative area and the extension in time of this negative area. And then, what does the negative area reflect? The exposure to financial risk. So on those years, from year 0, 1, 2, 3, and 4, this project has serious financial risk, because any problem with the cash flows, the receipts or the payments, will cause a deeper and negative cash flow. So this is important. Exposure to financial risk. One important fact that this chart, this project balance chart tells us, is the discounted payback period. This we know the discounted payback period. We studied in the lecture number 12, excuse me, 9, is the break-even, the discounted break-even. So we see here that the discounted payback is around 4 years. And also we see here in the positive area of the chart the profit potential. So those are additional profits that you are earning from your investment from the cost of capital. So at this point, in the discounted payback period, you have paid the interest rate. You have got the interest rate. And then any cash flows, any future cash flows that comes after the discounted payback period, as you know, is a premium you are receiving for investing in this project. A premium over the interest rate. So those cash flows, those profit potential, you have an interest of being very, very, very wide, and very high. And this is the final figure of the project, of this chart, is the surplus of the project. The surplus is the net future value of the project. And then if you calculate the net present value of this surplus, future surplus, this is the net present value of the project. Now, just to know this matter. One kind of specific project are the perpetual project. What are the perpetual projects? Are projects which their life is perpetual. It means that the planning horizon of the project is extremely long, more than 40 years. For example, when you build a new road, what is the life of this road? This will be a lot of years. Or, for example, if you are constructing in a city, the water sewerage, so this is long, very long term. So how do we calculate the net present value of those kind of investment that they start in time equal to 0 to at least time equal to 14 or 17 or 70 or even to the infinite? The way to calculate the net present value is a methodology called the capitalized equivalent. We know that we have shown that methodology in the equivalence of interest rates in the lecture number 4, I think, or 5. So we know this particular case of economic equivalence. So a perpetuity, as you remember in that lecture, is a stream of cash flows that continues forever. So as you see here, you have a future cash flow, periodic cash flow, constant and periodic, to the infinite. And then what is the project net present value of those cash flows? As you know, the formula, as we know that, is the equal amount A divided by I. So this is the capitalized cost of the project, the net present value of the project, or capitalized cost. And then A is the perpetual annual receipt, and then I is the cost of capital. Let's see an example. For example, it's quite useful, this methodology. You are the city mayor of a city, and then your city plans to construct a pipeline to transport water from a distant watershed area to the city. So we have a watershed around the city, and then this is the city, and then we are our city plans to construct this pipeline. This pipeline will cost $8 million. The expected life of this pipeline is 70 years, lot, so we can consider it an infinite project. And the city expects to keep the water line in service indefinitely. The city council will pay the construction of the facility, but this is its only role, to pay the construction. Who will be constructing and who will be operating this pipeline? A public service company, like in all the cities. For example, in Madrid is Canal de Isabel II, no? And the pipes and the sewerage of the city, of the Madrid city, are from the local council. And then it arises the problem that those pipelines have been financed by the local council, and the local council has to put a price for using those pipelines to the public service company is going to use them. So the public service company will run the facilities, but, and then, of course, the city council asks for a payment for using those pipes. So what we call in the terms of, in the case of public services, an annual royalty for the use of pipes. And then the financial criteria the city council had when they constructed, they built or they planned the pipeline, that was that the council wants to recover the initial investment over the life of the pipe. So they pay 8 million today, the local council, but they want to recover those $8 million dollars. They want to recover along the life of the project, supposedly is infinite. And then they will be asking, so this is the local council, owner of the pipe, he is the owner. So they pay the pipe, the initial construction, but one company, which is the, for example, in Madrid, the Canal of Isabel II, this one, and then we have here the citizens paying for their water. So this is the cash flow diagram, and then for using that and recovering their $8 million, the local council asked to Canal de Isabel II for a price, a royalty. So how we can calculate that? This is the first question. The cost of capital, we give that, given the cost of capital being 7%. Why 7%? Well, you can see that sometimes local councils or even regional authorities like Comunidad de Madrid, they issue bonds and private investors buy those bonds, and usually they pay for those bonds 7%. Why 7% is higher than the Spanish government? Because these investment local council or regions are riskier in terms of in the eyes of the investors. So first question is, what is the capitalized cost? And then returning to the previous slide, the capitalized cost is this one, the 2-day cost of the project. So the net present value of the project or capitalized cost. So first question is straightforward, 8 million. And then what are now is to calculate the constant and annual payments we will receive from investing today 8 million dollars, and the annual payments we will be receiving in the case of putting this money in a bank at an interest rate of 7%. So this is the conventional formula of payment, will be in Excel or in the financial calculator. N being the N a high number, or we can use the formula, because as you put here, infinite is impossible, but you can write in Excel or in a calculator 100 years. It will be like infinite. So using the formula and using the financial calculator, let me continue. Number of year, interest rate, I, in this case 7%. Present value is this one, the investment 8 million, and future value. In that case, future value is 0. So if you calculate that, it will be approximately 560. And then if you apply directly the formula, the formula is that the net present value of this investment, which is 8 million, this is the capital cost of this, is equal to A divided by I. So if we clear up A is equal to the cost, capitalized cost of times the interest rate, then the annual payment, the annual royalty is the 7% of 8 million. This is 560,000 euros per year. So it's a interesting way to calculate that kind of relation between business and local and regional authorities or public authorities when they invest. Or you can use also this, for example, for a roadway, or for example, like something like that. No, using the calculator, we have here clear 7% of interest rate, the present value 8,000 minus present value, future value is 0. And then let me explain that using, for example, 100 as the number of years, you see here the number of years is like infinite, and then computing the payment, annual payment, you see the same number, 560, than using the direct formula, 560,000. Next slide. Please let me know if you have any question, any moment, through the chat. Methods to compare mutually exclusive alternatives. So we have to choose among several investment projects. We have project 1, we have project 2, we have project 3, and we have to choose among them. What is the best? What will you choose of them? Then we need a net present value rule to decide on it. So an important fact is that the alternatives are mutually exclusive. So it means that if I choose project 2, I will reject project 1 and project 3. All of them fulfill the same function. All of them fulfill the same function. And then the election of one implies the other will be excluded. It's important to know that we are just considering projects with the same project life, because there is a particular case, which is the project with different project lives that needs specific considerations, and those are advanced for the course, and then we are not going to see, but you can find in many sources of how to do it. For equal project lives, compute the net present value of every alternative using its own cost of capital. It's important that every project has its own cost of capital. Why? Because, for example, the technology of one project, project 2, is riskier than the technology used in project 1. So the cost of capital of project 2, the cost of capital of project 2 will be higher than the cost of capital of project 1 because it has risk, higher risk. And then the rule is choose the project with maximum net present value. Clear, no? Let's see an example. A refining company considers two different alternative technologies to develop a new refinery. So they want to construct a new refinery. They have technology 1 and technology 2. Both have the same useful life of 20 years. The capacity of the refinery is 1,000 million liters per year, and the cost of capital is 12%. Just a consideration in relation to the inflation, which is 0%, just to simplify the case. Choose the most attractive alternative to invest. So this is the basic data we have from the technologies, from the alternatives, is that technology 1, the capex is 3,000 million, those are million euros, so 3,000 million euros, and the alternative 2 has a higher cost, a higher capex, 3,500 million euros, so it has an increase of capex of 500 million euros. The price per liter we are going to use, this is the output of the refinery, so the refinery has several raw material, mainly fuel, and it has a cost. And then to produce, also we have cost that depends cost on technology 1 or cost on technology 2. So one of the technology has cost advantage, production cost advantage. And then the output will be the same for both, which is petrol. And the petrol price will be the same, the same use for both, is for use of cars. And then the price is 80 euros in both cases. What is the cost per liter? In the first case, with the lowest capex, the price is 27 euros. Higher this cost than the option 2, the technology 2, which is 5 euros cheaper. So the cost of alternative 2, the cost per liter is 22 euros. As a consequence, this technology, the alternative 2, as due to the higher capex, this technology is more efficient. We expect that this technology is more efficient, and then we notice that in the cost of per liter is cheaper in the alternative 2. So we have to choose among them, and then we can calculate both project cash flows, project 1 and project 2. The capex for project 1, 3,000 million. Capex for project 2, 3,500. The receipts are the same for both, which is the multiplication of 1 million liters times 8.8, excuse me, 0.08, no, 0.80, 80 €. You see here also the same receipts in the project 2, and we have here the payments, the cost, the product cost. The product cost is 27 €, times 1,000,000 liters is this one. And in the case of technology 2, the cost of capital is lower, excuse me, the cost of production is lower, is 22 €. So the net cash flows every year in project 1 is 530 million, and in the case of technology 2 is 50 million euros higher, 580. Why? Because the cost of the product production process is lower. And then if we calculate the discounted cash flow for every year, for every project, we get a net present value of, in the case of project 1, 317 million euros, and the net present value of project 2 is 130 million euros. So, as you see, the project 1, net present value of project 1 is much higher than net present value of project 2. We are comparing 317 against is higher, much higher than 130. So, which projects we have to choose? The project 1, because it creates worth, more worth than the project 2 for the investors. So, as you see, the higher capex of investing in project 2, the cost efficiency you get don't deserve for the project. So the 50%, the 50 million per year, and at a cost of 500 millions of more investment, doesn't deserve for the merit of the project. So it's better to invest in that technology 1, which is cheaper and generates a higher net present value. So I think it's a clear example. So from now, have you got any question, students? So we have ended with the chapter, the lecture number 10.